in the corporate finance and investment industry. He started his professional career at Grant Thornton in 2015 when the corporate finance division was being set up. Prior to BDO, at the Facility for Energy Inclusion, a private debt equity managed by Lions Head Global Partners and funded by global DFIs, with a primary focus on small to medium scale renewable energy projects across sub-Saharan Africa. His specific experience includes financial modeling, financial analysis, investment analysis, mergers and acquisitions, business valuations, corporate and project finance. And now I'd like to introduce Zahir Sheikh. Thank you. So Zahir Sheikh, one second, is a partner in risk advisory, internal audit, and forensic services of BDO East Africa's offices in Kenya, Uganda, Tanzania, Rwanda, and Ethiopia. He's a dynamic leader with a high public profile and has been a market leader in his chosen markets and services. He was a regional partner responsible for financial advisory services in KPMG in East Africa, working primarily in Kenya, Uganda, and Tanzania. Zahir has over 35 years of experience, 2 years with BDO, 7 years in the UK, and 24 years of professional experience gained at KPMG in Kenya. He established the first forensics practice in Kenya in 2000 and grew it to a team of 25 full-time forensic specialists in the Eastern African region. And as regional partner of the Forensic Service Business Unit, Zahir has been involved in managing large and complex investigations, designing internal control systems, proactive fraud management services, and much more. And now I'd like to hand it over to Zahir to kick off this webinar. Thank you all for joining us.
Thank you so much, Meha, and a very, very good afternoon to all of you, or good morning, good evening, depending on where you're joining us from. I see we've got a good number of participants and hopefully a few others will join us. For those of you who may not have met me, I'm Zahir Sheikh, and I head the advisory division of BDO. Let me tell you a little bit about BDO. And here are our global statistics. BDO is actually one of the leading audit and advisory firms globally. Our turnover last year in 2023 was in excess of $14 billion US. We have a presence in 166 countries and territories, with 1,776 offices globally. And we employ over 115,000 professionals. So we have a global footprint. If you can look at the map to the right, you'll see shaded dark gray, and that's our coverage. So we've actually got a very significant footprint across the globe. Some of the services that we provide, obviously audit and assurance, which is our bread and butter, but increasingly so the advisory business is growing fast. So statutory audits, we do statutory audits, we do special audits, audits of donor-funded projects, as well as special purpose audits and reviews. We provide training such as this one in IFRS, as well as other accounting standards. And then we have taxation services, where we provide a full range of taxation services: compliance, advisory, tax audits, tax health checks. We have experts in transfer pricing, including international transfer pricing, employment tax and expatriate tax, international corporate planning, and also indirect taxes. We've got a particularly strong team to fight tax litigation cases, and we've got a strong record of winning cases for our clients. So if you've got a tax dispute, be sure to call us. Our other division is our business services and outsourcing division, where we provide outsourced services. So if you're a small business or a startup business, or you simply want to outsource some of your services, you can contact us. We provide accounting and bookkeeping services, compilation of statutory annual reports, management reporting, financial management, agent services, fiscal management services of assets and cash, payroll services, IFRS advisory services, company secretarial services, admin and accounting services, as well as legal advisory services. And finally, the department that I'm heading, which is advisory services. So here we provide internal audit, which is outsourced internal audit. So for those of you who have large internal audit departments, and you may want to outsource some of the service, typically by engaging a firm like BDO, you can save up to 50% of your costs, sometimes even up to 70% of your costs. So this is something to consider very seriously. Also, we provide a full range of risk management, risk advisory services, like looking at your risk policies, designing your risk registers, and so on and so forth. We provide a full range of management consultancy services, strategy consulting, development advisory work. We have a fully fledged corporate recovery or business recovery department where we have corporate doctors. So basically, this team can tell you what's wrong with your business, what's ailing your business, and how to basically get back onto the upward trend. And then we've got corporate finance and transaction services. Sajid here is one of our senior managers there. We provide valuation, deal advisory work, transaction advisory work, due diligences, and so on and so forth. And then my background is I'm a certified fraud examiner. So we also provide fraud investigation services. We have money hotline services as well. And we provide background checks, integrity checks. We do computer forensics. So we can do data imaging and disk imaging. And then we have a full range of technology advisory services, such as cybersecurity, cyber threats. And then we also have a department for data privacy and for sustainability services. If you look at BDO, just in corporate finance, which is what we're talking about today, we are one of the largest global players. Just last year, we had 1,744 completed deals. 31 of those involved private equity, and 21 of those involved cross-border. We are recognized as one of the most active advisors globally, and we've got a established practice in over 120 countries with 2,000 senior corporate finance professionals providing services. If you look down at the table there, last year we were first financial advisor globally in the FactSet league tables. And then the year before in the PitchBook league tables, we also came first. We were the most active advisor and accountant globally in 2022. And we came second as the leading financial due diligence provider globally. So let's start with a recap of what we covered in our last webinar. And our last webinar was nearly 2 hours. So I'm going to try and summarize that in about 10 minutes or 15 minutes. So obviously, it's not going to be too detailed. But for those of you who missed out, I mean, here's a quick summary. So in our last session, we journeyed through a company's life cycle and its financial needs at each stage, and the role played by the investors and investment products in its success. At the startup phase, where dreams take shape, angel investors, along with venture capitalists, they provide the initial fuel for product development. At that stage, it was all about equity financing and convertible notes to keep the momentum going, even when the revenue was just a trickle. And then at the proven products stage, where market recognition starts to grow and market love starts to come in, the venture capitalists stick around at that point, and the business gets an opportunity to team up with the private equity firms who are looking for growth opportunities. Equity financing and mezzanine financing become the go-to tools for scaling up and expanding your operations. And then fast forward to the high growth phase where things really pick speed, private equity firms and strategic investors, often large corporations, they step in, making private placements the secret ingredient for entering new markets and for fueling research and development. Then, in the strategic investment stage, collaboration and diversification took the spotlight. Here, strategic investors and private equity firms played a vital role, engaging in joint ventures to support your strategic initiatives and technological innovations. And finally, we reached the point where the company was ready to hit the big leagues and to go public. Institutional investors and private equity firms started to gear up for the IPO journey, navigating legal complexities and preparing for regional and global expansion. So in this recap of insights from our first webinar, the key takeaway remains: aligning each stage of the company's journey, which paves the way for steady growth and for success in a very competitive business environment. Next, we looked at the vibrant landscape of the African market, which offers diverse investment instruments, and the suitability of each depends on the unique needs of each business. We looked at equity, where shareholders' equity stands as a straightforward option, while private equity funds and venture capital bring in external support, targeting growth potential in your business. We also looked at mezzanine financing, which occupies the middle ground between debt and equity. We looked at instruments like warrants, options, mezzanine debt with the right to convert, and convertibles and safe notes, which provide the flexibility and balance the risk-reward dynamics. And then in the debt arena, corporate bonds provided a reliable funding with fixed interest rates, whereas convertibles offered a hybrid solution with potential for capital appreciation. We also dived into structured finance with innovative instruments such as sale and leasebacks, factoring, inventory-backed finance, securitization of collateralized debt obligations or CDOs, and project finance. These instruments offer tailored solutions for unlocking asset value, managing receivables, leveraging inventory, and funding large-scale projects. Lastly, we talked about two impactful methods: occasional concessional funding and also crowdfunding. So concessional funding through grants that offers a non-repayable support, which makes it attractive for projects aligned with societal objectives. On the other hand, crowdfunding in various models like reward-based or equity-based or donation-based that leverages digital connectivity to mobilize support for projects, products, and causes from a variety of interested players online. And then next, we covered diverse investor types as well. And this was to demonstrate their unique perspectives and contributions. We gave examples of international lenders such as Standard Chartered, who can provide financial support across borders, and it can even help mitigate things like currency risks and help you navigate through regulatory complexities across international borders. We touched on specialist lenders and guarantee funds such as MEGA, as well as mezzanine funds, such as Ethos Capital. We also touched on strategic corporate investors, for example, Procter & Gamble, who combine their financial acumen with industry expertise to bring a long-term perspective. And they emphasize synergies over immediate financial returns. And then we covered a broad range of financial equity and debt investors, such as DFIs, private equity, impact investors, venture capital, and so on and so forth. These entities operate with a focus on financial returns, each with specific investment horizons and goals. And finally, we had mentioned concessional financing as an example, MasterCard Foundation. These types of entities, they prioritize social impact over financial returns. And they're very useful because they can support smaller scale initiatives with flexibility in funding criteria. And then last time we visited the transactional landscape as well to understand the pivotal roles of key participants. So firstly, on the investor side, whether individuals or institutions, these are not just financial backers, but they are strategic players. They are the architects of growth. So their contributions, they actually go beyond capital. They also provide vital expertise. They come with the experience, and they come with a large network. And all of this, it actively shapes the company's trajectory during its expansion phase. And then on the flip side, we saw the seller side. They must become master negotiators, and they must be able to craft deals that meet the immediate needs while maximizing the overall enterprise value. They must be able to balance the financial considerations with the strategic direction of the business for sustained growth. And then finally, we looked at the other stakeholders, such as your legal experts who handle all of the legal complexities that comes with any transaction. And then we talked about the accountants who scrutinize the financial health and ensure that the numbers do stack up. We talked about compliance professionals who ensure adherence to regulatory standards and so on and so forth. Together, these stakeholders, they form the backbone of a transaction, providing essential checks and balances to safeguard the interests of all parties involved. And then we also had an overview of the complete investment process. And if you remember, in the preparation phase, we talked about how we created a clear roadmap and how we aligned the company objectives with the market dynamics. We emphasized that financial modeling must be able to provide a compelling story, and you do this by clearly articulating the company's financial performance through its cash flows and also your projected future growth. And then we also talked about deal structuring, where we define the terms and balance the investor attraction with the company's own interests. And then we also discussed the data room, which is a secure repository which showcases both the transparency of your business and data and also your preparedness for the due diligence. Because this is really important, because this is what instills the confidence in potential investors. Now, my colleague Sajan also covered in the last webinar the differing priorities of investors and investees. And then he also spoke about management considerations for the process. And then he provided some basic tips for the first timers seeking external capital. And then he went into the intricacies of the preparation stage. I urge any of you who find this introduction to be very brief, please take time, go to our webinar from last time, and you'd get the detailed talk on that. And now in the following session, Sarjan is going to cover the investor engagement stage, which is now the next stage. He is going to take you through the investor's perspective, what they are looking for, and what their concerns are. And then he's also going to talk about how we need to communicate effectively and build trust and so on. So it's now my pleasure to introduce you to my colleague Sarjan to take you through the remaining part of this webinar. Sarjan, if you can just share your screen.
Great. Thanks, there, and thanks for the welcome. Warm welcome to everyone. And it's good to see some of you back, and obviously new faces as well. Great. So, of course, we've looked at the preparation phase. We discussed the entire process, and this is the second stage of where we are now discussing how do we engage with investors, who are the right people to approach, and how do we deal with selling our story, or selling a story that an investor would want to look at. So on the first slide, first page of this, what we will be discussing is so first we're looking at the investor's perspective. What is the investor looking out for? Why would we want to engage with specific type of investors? And it's always important to understand what an investor is actually looking for. They have investment policies within them. They're funders or the investors, especially private equity funds, DFIs. Their actual funders also provide them with guidance on what they should be looking out for, and what type of investments they should be looking for. So it's important to understand what investors are looking for, and this allows you to then sell the story in the way you'd want to, and how they'd want to look at it, or have a review of the same. So when we look at what we're looking at from investors' perspective, so it's always important to know that investors are always often risk averse. They do have concerns, obviously, and they look at things from a more critical point of view than an actual investee or a business owner would. So the reputation of the deals team that works on it is at stake when they put a deal forward to their investment committees or the senior partners, and they need to put that confidence into them, and the trust that the deal that they are going for makes sense, and then probably get some advice back from the investment committee. The trade-off between risk and return is always a key consideration, especially in times of economic uncertainty as we have now, and much higher interest rate environments where obviously capital funding becomes much more expensive, and it ties back to risk from that angle. There's also a need to do thorough. There's a need to provide thorough details and rigor to closing the deals. So investment committees require deep levels of analysis and depth of information to sign off a deal and feel comfortable with the risks that they are going to be taking on board. And these investment committees and the senior board are usually made of very experienced people in specific industries and sectors. And it could be ranging from wide experiences in different sort of departments, ranging from finance to commercialization, etc. And most of these investment committees are usually part of board of directors in various companies within specific sectors. The next part is obviously ensuring that the technical analysis is covered well. So the investment teams that are dealing with, or that will be reviewing the deals or the deals that you provide to them, will thoroughly analyze all aspects of the deal, including running their own calculations and analysis of the financials, the market itself, the risks, and the better the data to do this, the easier it is to close up a transaction or get interest from investors to review this deal even much more into much more detail. The last thing to consider is that every investor is different. As I mentioned, every investor would have a different sort of investment policy, probably targeting different sectors, different ticket sizes, different types of instruments, and this is important to consider when you approach or engage specific investors. So it's always worth considering the specific needs and differences, and this includes the funding criteria, the interest in particular products, and the impact priorities that an investor would have. This is a key consideration for development financial institutions, and obviously we looked at donor funds and foundations that have a very strategic goal to target ESG and obviously environmental and social development. Again, backed by your sustainable development goals. So how do you engage with investors? What are the things that you would need to think about when you're reaching out to the various investors? And during that entire stage, the various engagements that will be taken on board between an advisor or an investee and the investor itself. As a process, it may be optimum to reach out to investors in phases to reduce the work at one time and the rest, and to test the market with a few investors, get their feedback, and further refine your message or approach to particular investors going forward. So the first part is obviously reach out to all the potential investors. You would have initially created an investor mapping exercise, which obviously is the initial stage of the investor engagement. This is where you identify the right type of investors or the potential investors that you could approach that fits your particular product or investment that you investment itself. So the first stage normally involves sending out introductory emails, meeting at various events. For someone based in East Africa, we have a very good network of private equity funds and venture funds. Again, a lot of DFIs involved, and this is the East Africa Venture Capital Association. We have regular meetings, regular events, regular conferences, and this is places where you meet various people or various investors at all levels, from a junior to the senior level, including investment committees, and this is where you build networks so that you can approach your emails to directly. And then obviously making phone calls to especially the people that you've really interacted quite a lot with over your career. When you're in regular touch with them, you always have that opportunity to always pick up a phone and introduce any particular opportunity. Obviously, subject to you understanding that this is the right investor for a particular investee. The second part is to present the actual deal, and this is where you're starting now off with the formal meetings, whether it's on video conference or in person, and you're presenting the investment opportunity using all your marketing documents that you've already prepared during the preparation phase. That is your information memorandum. It could be a pitch deck if you're presenting the opportunity in live. Obviously, generally, there's a need to always give an information memorandum ahead, so that obviously the deal teams that are reviewing it have gone thoroughly through all the details, but also being able to generate questions that they may have for you to understand the opportunity further. And all these presentations should provide a clear and concise narrative of the opportunity, focusing on how these narratives do align directly with the investors' priorities and goals. And then obviously the last part would be the question and answer. As I've mentioned, when you give the IM, you present a particular opportunity through analysis or initial analysis of the deal. They'll be looking at, or they'll have various questions that they would like to have answered, because these are the typical questions their initial investment committee is going to ask them, for them to even give a go ahead to even review the deal in much more detail. So these investors are likely to have questions about the opportunity, And it's important to always be prepared to address these in a much more clear and transparent manner. While doing this and making your investment pitches, rehearsal prior to formal engagement is always helpful. So it allows you to put up a best foot forward to the investor, ensure that you're very well prepared to answer questions, and obviously say that you've done your work before you even thought of approaching these investors. So what are the key considerations that you take from an investor engagement perspective? Obviously, the key is effective communication and trust building. It's important to build that trust with the investor, show them that they can have confidence in you. So it is important to engage quite effectively with the potential investors with the aim of building relations, trust, and to communicate the opportunities and the values that you are offering to the investor. So the first part is obviously, as I mentioned earlier, prepare and practice. Always rehearse, and preparing and practicing can allow you to have that flow and consistency of the message that you're trying to provide to the investor. It gives a strong view of the opportunity, and also it addresses the potential concerns, questions that a potential investor would likely have. You need to tailor the message to the needs and preferences of each individual investor or that you're approaching, and therefore it is always key to understand the investor's background and preferences. Always undertake the research. Obviously, when you do interact with numerous investors, you're also able to understand and get a gauge of what kind of investments they'd be looking into, what sectors they're looking into, what's the type of instruments. Are they only focusing on debt or equity? Is there a mezzanine option involved? And this is quite helpful when you've done your prior research on the investors themselves. The second part is obviously, the third is obviously having a clear and concise pitch that highlights the unique value of the opportunity that you're presenting, and this provides evidence for the potential growth and the profitability of the business without going into tangents. So obviously, every investor, while we say some may be more impact-based investors, there's always a case that an investor is looking for some sort of return, whether it be at market rates or slightly below market rates. But the idea is obviously to make a return. And obviously, when you're looking at private equity funds, DFIs, venture capitalists, they have been engaged by other individuals or institutions to ensure that they are able to gain a return. You always need to actively listen to feedback and questions that you got, because this feedback can be both invaluable to the process and the process of fundraising, and also identifying the potential risks of a business or a deal that you're presenting, because it may be a case where it has been overlooked and not thought about. It's important to never take this feedback personally, and try to endeavor and keep those relations. Always critical feedback is always good for development purposes, and obviously to make you think more outside the box, and obviously try and ensure that you capture all ideas, and obviously think of all possible mitigating options that you have. A timely follow-up and regular updates after the meetings that you've had, whether it's calls, whether you have to make a call, is always important. You need to show questions, which allows you to provide that display that professionalism and effectiveness of the company and the management that you are presenting is always good. So even after the initial, it's always good to go back, follow up, inquire additional questions. They may be requiring additional information or basic information that may be important to them when they're actually evaluating the opportunity. So during the initial or introductory meetings, this helped to build relationship and determine whether there is interest from any particular investor, and this will help you identify whether the deal will progress further or the opportunity is likely to proceed to the next stage. So first step is always to present the opportunity and the company background. Again, these are items that you've obviously covered in your information memorandum and investment pitch decks. Then you need to establish a connection between the investor and obviously the investee. See if there's a connection, gauge if there's mutual interest. Are they likely to be able to work together? Do they have the same goal in mind? It's always important to judge from an offset. One needs to be prepared, provide an overview, and always address the initial questions that an investor may have, and also think about questions that are likely to be asked from an investment perspective. And this can always be done through various networks. Always discuss, obviously, in a confidential level. Always trying to understand what are the potential questions that would be asked from a market perspective, or from an investment return perspective, or from a risk perspective as well. One needs to obviously avoid interpreting the early interest. Yes, things may seem that are interested to several parties from the offset, but obviously it's not always a given that they will commit to this to that investment. And we have various examples in our pipelines, or in our daily work, where we see investors well, at least 10-12 investors already showing interest from the offset, but once they go deeper down, it reduces down to less than 3 possibly. And so it's always important to understand that it's not always a given that every investor that shows initial interest will go further into the process. Key questions and concerns for follow-up should also be identified. You need to, obviously, based on the interactions when presenting the deal, getting that initial judgment of how investors are looking at it, or seeing what items they are trying to really justify from your presentation. Where is their key concerns? What do they keep on addressing a lot more is always good. Need to identify where the focus is, and this will allow one to obviously ensure that they're prepared in their questions, and obviously even prepare the data room accordingly, so that they're able to review this in much more detail and get the confidence. And again, as I said, what are the investors' criteria? Where are their priorities? Again, this is determined by the investment policy, the investment policies. And obviously, this is guided for funds. It's guided by the initial individuals or institutions that provide them with the funding. But from a strategic investor, it might be a different perspective completely. It may be a case of market growth, reaching out to new untapped markets, or potentially acquiring more market share through acquisitions or mergers. So once you've had that initial meeting to discuss the deal in perspective, obviously one needs to go into the next formalities, which is obviously signing the NDAs, sharing more detailed pitch decks, or obviously detailed information memorandum, or possibly when getting a sign off to get a due diligence or data room in place, or review the data room. So I've mentioned NDA, or non-disclosure agreements. So what are these? And this is what we basically call confidentiality agreements. And a confidentiality agreement. So what is a confidentiality agreement, right? This is often and how are these done? These are done through non-disclosure agreements, which is a legally binding document that outlines the terms and conditions of keeping sensitive information confidential between two or more parties. So as an investee, you're sharing quite a lot of your information, your sensitive information that could impact your business, encourage more competition, and it's always important to ensure that you've signed these agreements, so that you do not have a case where that sensitive information is shared to other parties, to your other parties that could be a direct competitor to you. So what is a confidentiality agreement? Why is it important? So firstly, it is a mutual agreement that is intended to stop the sharing of confidential information without the prior written consent from the investee or other parties, or management or board of directors. The companies that are looking to raise fund, they will allow them to share information with potential investors without the risk of that information being used against them, as I mentioned, being shared with competitors. And an example would be a private equity fund may have been invested in one of your competitors, and if this information leaks out, or they get that information and sitting on it, they could use it within the other portfolio companies that probably are direct competitors. The confidentiality agreements also help to maintain the trust and help enter into investment discussions in good faith. So what are the key elements to these sort of agreements? So definition of confidential information. Your NDAs need to define what information is considered confidential and what is not. It also allows for permitted use. So it allows one to outline the specific purposes for which the information can be used and for which it cannot be used. It also specifies the term of the non-disclosure agreement, so that's basically the duration of confidentiality that is required from the investor or parties that you sign that agreement with. It also provides exclusions, so it also identifies information that is not considered considered confidential as well, and those are the exclusions, and those are items that could definitely be or could be shared across. It also provides remedies. So what do we mean by that? It allows one to outline remedies that will available or enforce in a case there's a breach of this arrangement. So you may have a dispute resolution. What are the governing laws? What courts would be used if it gets to a point that there was a breach of this agreement and confidential information has been leaked out? And also arbitration, who the arbitrators are likely to be. So all these are provided within these agreements. And as I mentioned, these are legally binding. So it's always worth agreeing on an NDA prior to sharing any detailed information, whether it's a financial model, an information pitch deck, anything on your data room, even if it's a contract with a particular client or a supplier. It's always important to have these documents, NDAs signed. When it's signed prior, you can then make this process much more smoother because it is probably going to, the terms of the agreement are likely to cover the entire period up to the investment point. And that's something that's quite important. We always recommend having legal advice when drafting and agreeing to the terms of a confidentiality agreement. There are cases, and a lot of cases, especially with the larger funders who may be DFIs or commercial banks. They typically tend to want to use their own non-disclosure agreements because the legal process are a lot more stringent. So it's always important to have a legal team that reviews most of these items in the non-disclosure agreement, so that it allows you to be confident and put trust into the investor that yes, we will be covered, and obviously you don't want detrimental clauses on you, despite you being the one who's going to share the confidential information. The next point, and what we looked at, was obviously management presentations, and obviously what needs to be done during these presentations and how do you communicate your message. So the management presentations generally cover the following items, and this need to be thorough, transparent, and obviously coherent with the story you're trying to sell. So it needs to present briefly the coherent story of the opportunity, highlighting the specific areas of the information memorandum across the team, the company that you're working with, the products or services that are being provided, what is the growth strategy of the business going forward, and obviously the financials, whether it's obviously historical performance, but obviously going forward as well. These presentations also need to demonstrate the competence and cohesion of the management team through strong preparation, articulation, and answering of questions. So again, especially at the point where we're looking at ventures, the investments are not based on, or not typically based on, financial requirements, but are based on an investor investing into the management team and how strong or how much do they believe in a particular particular management team for them to grow business from one size to the next and probably become a much larger business, and probably even be classified as a unicorn, which is the term that we use now for the most famous startups. It also needs to consider the priorities of the investors and the company to assess how the potential partnership would work. That is, when you're bringing on board an investor, what is the strategic input they're likely to give you? How are they going to assist you to grow this business from one size to another? What is their input, and how are they going to be sitting on the board of directors and driving that strategy for growth? It also has to share the mitigations for any perceived risks that may be there, especially from the deal itself, and also addressing concerns and questions on things that may not be completely straightforward from the initial point. So you'll see where we're looking at how we try to mitigate some of these issues of partnership clashes, etc. When do they sit on the boards? When do the board really need, or board with the investors on it, need to be seated to make strategic decisions? Or how much leeway do you have as an investing company or the management to make certain decisions without the approval of the board, with the investors being present? Although these presentation materials may be straightforward, the way in which this opportunity is always conveyed, the level of capabilities that is demonstrated, and the ability to answer questions competently are important in creating a good impression to investors, and that is what needs to come out through management presentations, so that they're confident that they're dealing with the right person to take this business forward. So from once the management presentations are done, there's interest shown, possibly a non-binding offer has been given. You move on to the next stage, and you'll be continuously engaging with investors during this phase, and this is the due diligence. And what are the considerations that one needs to undertake when you're engaging with investors under a due diligence perspective? So there are 5 key steps during a due diligence phase. First one, obviously, review the financials. So that means you need to organize your financial records, including your financial statements, your tax returns, bank statements, and ensuring that they're up to date, accurate, and they're complete. So they're all fully transparent data that you're providing. There's nothing that's being hidden. And obviously, it is also worth identifying the inconsistencies and issues preemptively. So it's better you identify initially, so that you've addressed it when the investor does engage with you. And be prepared to explain any negative trends or fluctuations in revenues, expenses, margins, any downside impact that may deter an investor to looking at this business further. The next phase would obviously be reviewing legal documents. So it's important to make sure the company legal documents are valid and up to date. And these include the article of incorporation, bylaws, contracts. This may be contracts with suppliers, with buyers, with lenders. Also looking at your licenses and permits, and obviously all your regulatory filings, whether it be with a particular regulatory body or with the tax authorities. You need to consider that all of these are in line and have been filed. Once you're able to identify any potential legal issues, any sort of pending lawsuits, any sort of issues with employees, it's important to always be sure that you're prepared to explain and plan to address these negative questions again, and obviously put that trust that you're being transparent and fair to an investor. You also then need to ensure the company's operations are completely organized and are documented. This includes all your standard operating procedures, employee contracts, the human resource policies, and it's always important, or it's always worth reviewing the intellectual properties. This includes your patents, your trademarks, your copyrights, and all this documentation, if they're applicable to you. Ensure that all this is organized in the right manner, so that the investors are easily able to track this during your engagement sessions. Then you need to identify risk that a company is likely to face, such as competition, obviously threat of new entrants, threat of substitutes, and what are the changing market demands, market conditions, or the changes to government policies. There could be cases where we're seeing that trend where we're now looking at tax revisions for different sectors, for potential ban on sort of importation of raw material or any of these kind of issues, it's important to obviously identify this or try and at least predict this in advance, so that you have covered you've got a mitigating factor to cover those risks. And obviously, to mitigate these identified risks, there needs to be a risk management plan that has to be put together and explained to the investors on how you aim, or how you're going to be tackling these issues if they do pop up in the near future. And then obviously you need to document outlining the you need a document that outlines the company's products, services, what's the target market, who's the competition, obviously marketing strategies, how do you aim to go into the market, what are your growth plans, which sort of product diversification are you going to be undertaking, or market diversification is there within your pipeline or in the near to medium term future. And again, this could be a series of detailed documents or references that you would obviously be in the data room, or it could be inbuilt into the IM directly, as long as it's capturing the story completely. And always the advice is to ensure you have the right transaction advisor to ensure that all these are covered. And then obviously the last potential part of this session and what we're looking at, and which is always a very key part of a due diligence, is the site visit. As transaction advisors, it's also key for us before you even move on to doing any sort of assignments. It's always good to get to have a site visit, because it provides a deeper understanding and context of the opportunity that we're dealing with. So site visits are a common part of the due diligence process in deal making, and it involves physically visiting and inspecting the property or the facility, whether it's a factory, whether it's a real estate project, whether it is a renewable energy project, or whether it's another business from an agriculture perspective as well. So a site visit is always important. Obviously, you need to allocate ample time for the investor visits. This is to consider conditions, identify any potential risks, or the reasons why these site visits are done. They want to understand the condition, identify any potential risks that are present, or what are the other opportunities that they see, and as an investor you're not seeing it as well. And obviously get further information that is otherwise difficult to ascertain when there's no documentation, or understand the business process. How do you move? Is it from a factory perspective, what's the layout? How do things move about from raw material to finished goods? And from the point of view of a company that is seeking investments, it is worth allowing enough time and attention to these visits, ensuring that your key personnel, so your key engineers are present from a manufacturing point, your financial team is present, your sales team is present, obviously your HR team is present, and obviously your possibly your safety engineers as well. And it's good to have these key personnel available at all times. And you should be preparing for the site so that they are presented at the best light, and it doesn't show them things are not managed correctly, and it's a more secure and stringent process within the company itself. So, I mean, that's ideally the end of this session of engaging with investors. These are the key steps when you're looking at it. So we need to understand the investors' perspectives. What are they going to be looking for? How do you answer or give the story directly to what they're looking for? Being prepared for the questions, ensuring your data room is comprehensive, allowing for various sort of meetings. It's a process. It's not a one-day or a one-time meetup between investors. It's a marriage that you're getting into. So it's a long-term commitment from the investors as well. So it's always good to be constantly in touch, and obviously be regularly interacting with the investors, so that you're able to successfully complete the transaction process. I will now hand over back to Zahir for his final comments, and then to Meha to conclude.
Thanks, Sachin. Yeah, well, I hope you've all learned a thing or two. We have another webinar coming up next month. So please do join us for that. Do join us for the complete series. And if you've got any burning questions, we can take those now. Otherwise, I'll hand over to my colleague, Meha.
Thank you so much. I'd like to thank Zahir for introducing BDO and giving us a recap of the previous webinar. Thank you for that. And obviously our expert panelist, Sajid Shah, thank you for a very insightful webinar today. It was very straightforward, easy to understand, and that may explain why you don't have any questions. But if you do have any questions, please do type them in the Q&A session right now. And if they don't relate to this webinar, if you want to know more about like BDO services, what we offer, feel free to take this time and ask the questions, as we have a partner and a manager here